Milestone number 4 of closing your first deal, secure financing. Now, before you put an apartment building under contract, you should clearly understand your potential lender's loan terms and underwriting criteria. Otherwise, you might put a deal under contract and assume a down payment of 20% only to find out later that you'll need 30%. Or maybe that you don't personally qualify for the loan and need to find a co-sponsor. Or that the lender requires a 6-month reserve that you didn't count on. But let's go over the loan process, what lenders look for in a borrower, and 10 questions you need to ask your broker. Hey, I'm Michael Blank. I'm a full-time entrepreneur, investor, and coach, and I'm passionate about helping others become financially free in 1 to 3 years by investing in real estate. Through my investment company, Nighthawk Equity, I control over $300 million of real estate, and I've helped my students acquire over 14,000 units at the time of this recording. So hit that subscribe button and notification bell if you want to learn more about financial freedom. While ignorance is sometimes bliss, in this case, these kinds of surprises could cost you a deal. And when you're doing a deal, you don't want surprises like this. The lesson learned is this: clearly understand the terms of the potential loan and how the lender will underwrite the deal. Remember, underwrite is a fancy term that refers to how the lender assesses the risk of a project, what they require of you as a sponsor to mitigate those risks, and how it satisfies their lending guidelines, and the ultimate terms of the loan. Now, to understand your lender's underwriting criteria, make sure you network with potential mortgage brokers or lenders long before you start making offers on deals. But what do lenders really look for? And what questions should you ask? In this section, I'm going to share the most common underwriting requirements and terms you can expect from a commercial lender, and also how you can satisfy their lending requirements, even if you don't qualify yourself. What lenders look for in a borrower. As you meet with loan brokers or lenders, give them multiple scenarios and ask what they're likely to require to approve the loan and what terms might look like. What would the terms look like for a stabilized asset? What about a distressed value-add deal? What would a bridge loan look like? So here's some of the key loan terms and underwriting requirements and what to look for. Debt coverage ratio. The debt coverage ratio is the ratio of your debt service payment to the net operating income. So for a stable asset, the lender will look for a ratio of 1.25 or higher. Now, if it's a value-add deal with little cash flow in the first year, for example, they may relax this requirement in return for an interest reserve at closing. Loan to value. The loan to value is the ratio of the loan balance to the value of the asset. So for stabilized assets in good areas, banks will lend up to 80% of the value. I use 75% in my projections, and even lower if the property is not stabilized. Net worth. Lenders are looking for a net worth of the sponsors that's equal to or greater than the loan amount. Now, if your personal net worth does not meet these requirements, partner with someone who's willing to sign the note with you. Offer that partner some additional equity in the deal or pay him or her a fee at closing. Liquidity. Lenders like to see liquidity among the sponsors of 10% of the loan balance or greater. Typically, they don't require you to keep this in a separate account. They just want to see that level of liquidity in the sponsor's personal financial statement. If you have a partner signing a note with you, then the bank will also consider that person's liquidity. Personal guarantees. Banks like personal guarantees. Loans that need to be personally guaranteed are also called recourse loans. This means that if you were to default, the bank could go after your personal assets. If you want to avoid personal guarantees in general, not only for yourself, but also for any investors you have involved in the deal or partners. Your investors are typically limited partners with limited decision-making authority, and they're not investing with you to take on any more liability and potentially losing their principal. So for loan amounts under $1 million, the banks generally want a personal guarantee. Interestingly, the higher the loan amount, the more likely you'll get a non-recourse loan. Another reason to try to go big as soon as possible. Now, you can negotiate personal guarantees and any other terms of the note. For example, you might be able to bleed off the guarantee, which means that the amount of the guarantee decreases over the years. Bridge loans normally require or tend to require a personal guarantee, but then can go away once the asset has been stabilized. And as a syndicator, I am mostly concerned about the recourse, net worth, and liquidity requirements because my personal financial statement may not support the kind of asset that I'm looking for now. This means I too will have to or may have to partner with someone to make up for their shortcomings. Now keep these key points in mind. Partner. Don't limit yourself to your own personal financial statement. If you're maybe a little weak there, then partner up. Find one or more investors who complement your net worth and liquidity requirements and partner with them. Number 2, go big as quickly as possible. You don't want to have to personally guarantee a bunch of buildings, do you? Limit your personal liability as much as possible. Negotiate the loan documents also. Then shoot for bigger assets so you can get non-recourse loans. Number 3, talk to your lenders early. Be in touch with lenders long before you have your deal under contract so that you better understand their underwriting requirements. This allows you to get your ducks in a row ahead of time so that you can close on your deals. Now, as with most things in business, it's all about relationships. Build a relationship with your lenders now so that when you really need them, they'll come through for you. That's a lot to remember, so if you're looking for a bit more help, then book a call with my team at themichaelblank.com/call, and we'll see if we can help you out with some additional programs that might be really helpful for you. The top 10 questions you need need to ask your commercial mortgage broker. In your interview with your commercial mortgage broker, ask them these 10 questions. Number 1, what are the basic terms I can expect for a typical loan? Specifically, what loan to value or loan to LTV, what interest rate, what term, and what amortization can I expect? Number 2, is the loan non-recourse or does it have to be personally guaranteed? Number 3, what are the costs of the loan? Specifically, what are the origination fees? And typically they're 1% of the loan. What is the cost of third-party reports such as the appraisal, structural and environmental reports, and legal fees? Number 4, what size loans do you typically do and in what areas? Number 5, what are the prepayment penalties, if any, if you decide to refinance or sell before the term of the loan? Number 6, what are your liquidity and net worth requirements? Typically, the lender will require the sponsors as a whole to show liquidity of 10% of the loan and a net worth equal to the loan balance. Number 7, do you require any reserves or minimum account balances? Lenders want you to deposit 6 to 9 months of interest payments into an escrow account or keep minimum balance in a bank account. Some also want you to bank with them as a condition of the loan. Number 8, what is the typical time to close from the time I order the appraisal? Normally, loans take 45 to 60 days from the time the appraisal is ordered to close. Make sure you know the time frame for this lender so you can close on time. Number 9, how do you define a stable asset? Typically, assets that are at least 80% occupied are considered stable, but some lenders require higher occupancy as well. Anything less is considered distressed, which means you need a different kind of loan product. So if you're talking to this lender about a conventional loan for a stable asset, make sure you know what they consider to be stable. Number 10, what kind of loan products do you provide? Lenders could provide one or more of these loans: conventional loans, Fannie Mae, Freddie Mac, these are government-backed loans, FHA HUD loans, bridge loans, and/or construction loans. Now, ideally, the more products a broker can provide, the better. Now, with any conversation you have, at least if you're like me, I can't remember anything, keep copious notes, and then add the answers to a spreadsheet where you track the nuances and terms for each lender. Now, do this for 3 to 5 lenders, and you'll get a good idea of what's normal and what might be a bit unusual. Now that you have the answers to all these questions, you're going to better understand your lender's requirements to ensure you qualify for the loan, number 1, and you know the actual terms for your own analysis for deals. Therefore, once you have a deal on a contract, and when time is of the essence, you already have a relationship with a broker, you know what terms to expect, and you're confident that you have a very good chance of being approved. Following the steps I just talked about will dramatically increase your chances of closing the deal. So now that we understand our lender's requirements, let's review the loan process and timing. But first, go ahead and hit that subscribe button and notification bell for more videos like this in the Ultimate Guide to Financial Freedom with Real Estate Investing. Appreciate it. Thank you. The loan process and timing. Let's talk about the loan process and timing. The first step in this process is to complete a loan application and provide preliminary information about yourself and the deal. Now, once you have a deal on a contract, you want a term sheet, what's called a term sheet, from your loan officer as quickly as possible. Now, a term sheet is a short 1 or 2 page letter that outlines the main terms of the loan, pending, of course, final underwriting and approval. You can use a term sheet to compare different lenders with each other and then select the best terms for you. I found that the lenders take 1 to 2 weeks to produce a term sheet from the time they get the deal package from you. After you receive the term sheet, the ball is in your court. The next step is for you to select your lender, which typically involves you ordering and paying for an appraisal. Normally, the bank will require you to pay a non-refundable deposit that will cover the cost of the appraisal and maybe a few other things. The amount of this deposit is negotiable to some extent, but banks tend to be set in their fee structures in general. The appraisal typically takes 21 to 30 days. I still don't understand why it takes this long, but it does. But the point is, once it's completed, your loan will enter final underwriting, and this may take another 2 to 4 weeks. And the outcome of this process is a commitment letter that is a definite yes to the loan and its terms. Normally, the terms are substantially the same as the term sheet, unless the underwriter discovers things about the deal or they don't like something and they have to adjust the terms accordingly. Once you receive the commitment letter from the underwriter, it takes another 14 to 21 days to close. Now, while there are always exceptions, plan for the bank to take at least 45 days to close once you order the appraisal. I would almost say 60 days is better. Now that you've picked your favorite lender and understand the requirements and the loan process, make sure you hit that subscribe button and notification bell so you don't miss any videos about achieving financial freedom. In the next video, what we're going to cover is we're going to kick off the closing process. So let me know your thoughts or questions in the comments below, and see you in the next video.